Good morning everyone and welcome to today's morning report. Trust posted on Friday the 6th of January with me, Rich Pro Market Analyst at Antec Markets. We've got a bit of a consolidation move on the equity markets, slightly lower, just drifting off actually as the European session has sort of started to get some legs in it. But the dollar has rebounded. It's been weak for the last couple of sessions. And that's broken back below 102 on the trade-weighted dollar. And there couple of factors I think playing out in this one. First of all, the treasury yields. We've seen the 2-year and the 10-year breaking lower. Now that is interesting because look at this spread between the 2s and 10s, sharply lower in sort of opening week of 2017 and back to a sort of a level that we hadn't seen since early November, back below that 1.2% or 120 basis points. And that is, I think, one of the drivers of the dollar weakness. The other one is this chart here, the Chinese yuan, which the Chinese government has brought in some measures to sort of curb the exit of Chinese yuan out of the country, and that sort of strengthened the yuan in the last couple of days. But the bounce that we've seen today has come as the fixing, the daily fixing, came in as sort of higher than expected on the yuan. So it was it sort of generated a bit of a rebound, and that has helped the dollar rebound a little bit today as well. Now, it is Non-farm Payrolls Friday, so that will be the main focus, I think, of markets today. And let's have a look at the estimates that we've got for these Non-farm Payrolls report. 178 on the headline, 4.7 on unemployment, 0.3% on the monthly average earnings. And let's have a look at what that does for the chart, or the charts, I should say. That would be sort of in line with where we were last month on payrolls, basically sort of where we need to be. Unemployment ticking mildly higher, so sort of flattening unemployment, you could argue, certainly if it comes in at 4.7%. This will be the interesting unemployment level, though. The the U6 unemployment level, which shows the unemployed, underemployed, and discouraged, basically drags in all the different aspects of real unemployment in the States, and that's at 9.3%. But that is still a level above what is around 8.3%. Which was the average of 2006-2007, so there is still a bit of room for that to fall. You've got the average hourly earnings, which last month were negative by 0.1%, expected to come at plus 0.3, so that would actually improve the year-on-year average hourly earnings to about 2.7% again. We'll also be interested in the labour force participation rate, which has been falling for the last couple of months. What you'd want to see is the labour force participation rate improving, and that improvement coming amidst unemployment sort of either flat or lower, because an improving participation rate basically brings people back into the labour force, and if that's the case and they haven't got jobs, then the unemployment rate will be increasing. So you'd want to see the participation rate rising whilst the unemployment rate is falling. So that's basically the Non-farm Payrolls report. You take it in aggregate, I'd say, and the expectation of 178 will be interesting, because ADP the other day came in at 153. That was well below the 170 expected there, so maybe sort of in for a bit of another neutral to mildly disappointing report, and that could lead to further dollar correction if that were to be the case. So it'll be interesting to see how this all plays out. Now, my chart today is Euro Yen, and I think Euro Yen will be a chart that does move on this payrolls report, because the yen is a very sensitive factor, or the dollar yen is a very sensitive factor, and obviously how the Japanese yen moves as a safe haven in response to the Non-farm Payrolls report will be interesting. Now, we've seen this market that's basically flattened off. We had this strong run through November, December, or the first half of December, flattened off in the last few weeks really, and it seemed to be sort of putting pressure on the 122 level. Now, 122.05 is interesting because that is a key sort of old breakout level. So that's holding on to that breakout at the moment, but the negative candles are stacking up. And yes, we've had this bit of a rebound early doors today as the dollar has rebounded and the yen safe haven has sort of taken a bit of a hit. However, I would argue that looking at these momentum indicators, it's basically they're all sort of drifting in a corrective mode. And it'll be interesting to see if the stochastics continue to fall back, then we could see, certainly if that went below below the 40 level on the stochastics, and that could put pressure on the 122 support level, and then put pressure on this 121.55 level, which would be the possibility of a breakdown. So if you see a weak payrolls report today, that would be yen strength, and that would, I think, put pressure back on the 122 figure level, and then ultimately possibly the hourly chart showing 121.50 being the key support. So you've got the momentum indicators, which are sort of neutrally configured near term. That's not to be unexpected in front of payrolls. 123.13 was the high basically on Wednesday, and it's again coming as resistance today. It's 123.30, and then sort of back towards sort of 123.75 area being the resistance. So you've got a sort of near term, I suppose, with this little rally that we've had today, near term neutral, but as I said, pressure is mounting, and the sort of negative candles that we've seen in the opening sessions of 2017 have sort of put a bit of a corrective spin on it back towards that 22 figure level, so that would be a key level to watch. So I wish you good luck in your trading on Euro Yen today and across the Forex majors on payrolls, and I'll speak to you later. Thank you.